Common stock risks in the stock market. Investing in common stock offers the potential for significant returns, but it also carries inherent risks that investors should carefully consider. Here's a breakdown of the key risks associated with common stock investments in the U.S. market. 1. Market risk, fluctuations. The stock market is inherently volatile. Stock prices can fluctuate dramatically based on various factors, including economic conditions, investor sentiment, and geopolitical events. Systemic risk. This refers to the risk that the entire market or a significant portion of it could decline, impacting all stocks, regardless of individual company performance. Market corrections and bear markets. History has shown the stock market goes through periods of corrections and bear markets, which can result in significant losses to investors. Second, company. Specific risk, financial performance. A company's stock price is closely tied to its financial performance. Poor earnings, declining revenue, or increased debt can negatively impact the stock price. Management decisions. Company management's decisions, such as strategic investments, mergers, or acquisitions, can significantly affect the company's prospects and stock value. Industry-specific risks. Companies operating in specific industries may face unique risks, such as regulatory changes, technological disruptions, or shifts in consumer preferences. Competition. Increased competition in the marketplace can cause a company's stock value to decline. 3. Liquidity risk, difficulty selling. Some stocks, particularly those of smaller companies, may have low trading volumes, making it difficult to sell shares quickly or at a desired price. Bid-ask spread. The difference between the price a buyer is willing to pay, bid, and the price a seller is willing to accept, ask, can be significant for illiquid stocks, resulting in higher transaction costs. 4. Inflation risk, erosion of purchasing power. Inflation can erode the purchasing power of investment returns. If the return on a stock investment does not outpace inflation, the real return may be negative. 5. Interest rate risk, impact on valuations. Rising interest rates can make bonds and other fixed income investments more attractive, potentially leading to a decline in stock valuations. Increased borrowing costs. Higher interest rates can also increase borrowing costs for companies, which can negatively impact their profitability. 6th, regulatory risk, changes in regulations. Changes in government regulations can impact specific industries or companies, affecting their profitability and stock prices. SEC regulations. The U.S. Securities and Exchange Commission (SEC) enforces regulations aimed at protecting investors and maintaining fair and efficient markets. However, regulatory changes can sometimes create uncertainty and volatility. 7. Geopolitical risk, global events. Events such as wars, political instability, or trade disputes can create uncertainty and volatility in the stock market. Important considerations: diversification. Spreading investments across different stocks, industries, and asset classes can help mitigate risk. Due diligence. Thoroughly research companies and understand their financial performance, industry, and competitive landscape before investing. Long-term perspective. The stock market can be volatile in the short term, but historically it has provided long-term returns for patient investors. Seek professional advice. Consult with a financial advisor to develop an investment strategy that aligns with your risk tolerance and financial goals. Warning: investing in the stock market is risky. Be sure to do your own research and consult with a financial advisor before investing. This information is not intended as investment advice. The author and publisher are not responsible for any losses incurred.